Hello and welcome to this session in which we will assess control risk. In the prior session, we looked at obtaining an understanding of control risk or internal control. What does that mean? It means we're just learning how the system works. That's fine. Now, after we learn how the system works, and there are three methods to do so, if you remember, narratives, flowchart, and internal control questionnaire. Now we need to assess how does it work. Simply put, we need to look at the design. We know how it works. Let's look at the design. And bear in mind, we're looking at the design, not the effectiveness. Matter of fact, we're looking at the design. Maybe we might test its effectiveness. So based on the assessment, and we could assess the controls as low, medium, or high. Remember, the higher the control risk, the worse the controls are. So we want to have low. It means they have good internal control. If the design is acceptable, if we say the design is low or medium, then we will test its effectiveness. Why do we test its effectiveness? If we are going to assume that the design is good, we test its effectiveness to rely on it. So the only reason we will test effectiveness if we accept the design. If the design, we look at the design and the design is not acceptable, we don't test effectiveness. Why? Why test something that you are not going to use? You don't test because the design itself is not acceptable. What does that mean? It simply put, you don't rely on their internal control. Worse, you don't take the internal engagement audit because it's too risky. Their internal control is so bad. But it doesn't get to that point, but it could be. All what you are doing at this point is making a preliminary assessment about the internal control because you're going to reassess at the end. But this is what you are doing. And remember, the reason why we need to learn about internal control risk is the audit risk model, which is audit risk equal control risk times inherent risk times detection risk. So the control risk is part of the audit risk model, and we discussed this in a separate recording. Some companies may not be auditable altogether. It could be a huge mess if the management lacks integrity, or the accounting record are deficient. Accounting record are deficient means their internal control is basically poor. Well, if that's the case, we don't audit the company under those circumstances. But in this session, we're going to be focusing on assessing control risk. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. What is the starting point in assessing the design of the control risk? Well, what you will start with is entity level controls. What are entity level? It means controls that are designed overall. Overall means that they affect the company as a whole. Well, what are those? Well, we can look at control environment issues. Remember, top management, involvement of shareholders, board of directors, senior executives. We'd look at the control environment. That's one group we can look at. And the other group we can look at is, the other thing that we can look at is general IT controls. So we will start there. What are some examples that we would look at? Ineffective board of directors, if that's no good. Well, or if it's good. No process to identify, manage, or assess risk. If they don't have this, those are part of the control environment. Misstatement across all system applications because we have bad general IT controls. Our IT controls are failing. We don't, for example, we don't safeguard our assets, which is the data, or anyone can go into the system. There are no passwords. Well, or inadequate safeguard of data files. If we don't have those, forget it. We're not going to even do anything with this company. We're just going to let it go. So we're going to assume here that all of these issues are resolved in a sense that they are good. And once we assess the entity level control, say, yes, it's good, let's keep going. Then the auditor moves into transaction related audit objective for each major type of transaction in each transaction cycle. And what they use, which method did they use? They use something called control risk matrix. And for the sake of illustration, we're going to be using the sales cycle. And the reason I choose the sales, because in the prior session when we looked at internal control questionnaire, we discussed the sales cycle. Therefore, we kind of carry on the illustration. So let's take a look at a matrix. So I'm going to show you what it looks like. On the top right here, horizontally, you have the audit-related objectives such as occurrence, completeness, accuracy, posting and summarization, classification, timing, presentation. Audit-related objectives. And for example, this is for the sales. For example, occurrence, recorded sales correspond to actual shipment made to real customers. All existing sale transactions are documented. Completeness, so on and so forth. You can read them if you like to, of course, but what I'm trying to tell you is on the top you have the audit related objectives. Now on this side here, on the left hand side, what you have is the controls, and here are the controls, and I listed 11 controls. You could have more controls, and what I'm going to do, I'm going to look at the control and match, for example, C1. Which audit-related objective does it satisfy? Because if I'm looking at sales, and obviously by extension account receivable, I'm looking to see what controls do I have that meets the sales and the account receivable objective. Let's take a look at controls and see how we are meeting those audit-related objectives. One of the controls that we have, computers automatically approves credit by comparing it with the pre-authorized credit limit. So what does that mean? It means we don't make a sale unless we check the customer's credit. So we are actually selling to actual customers. So if that's the case, we are satisfying the occurrence audit-related objective. Recorded sales correspond to actual shipment because we are checking someone's credit. This tells us we have a real customer. Recorded sales are backed by authenticated shipping document and approved customer order. Simply put, before we record the sale, we want to make sure we have an approved customer order. Everything is good. We approve them. The credit limit is good. And we have authentic shipping document. What are we making sure we have here? Well, we're making sure that the sale took place, the occurrence. Also, accuracy, because if we have those and we're looking at them, approved customer order, we assume we are checking things out. That's also meeting the accuracy. There is a distinct separation of responsibilities between billing, recording of sales, and cash receipts. What would that do? Well, if there is a separation of duties between these three departments, for sure we're going to know whether the sale is an actual sale or not, because a lot of people are checking. We're going to make sure that all are completed. So because we are checking the billing to the recording to the cash receipt, so we're recording everything, and posting and summarization, because the billing is making sure is updating the record, the sales, and cash receipts. So we have posting and summarization. Shipping documents are sent daily to billing and processed the following day. Well, shipping document on a timely basis is sent to billing. It means we have an actual sale because we have the actual document. And remember, the following day, it means in a timely fashion. We are meeting that objective. Now what you can do, you can just go ahead and match the control with the audit objective. Take a look at it just for the sake of illustration. Now if you Google audit related objectives, or what we call the internal control questionnaire, you will find a lot of them. But I just want to let you know that you can just look at these. Now I'm going to look at the deficiencies. And when we look at the internal control questionnaire, what we find out, there is a deficit in internal verification process allowing for potential duplicate sales invoice recording. Remember, they don't account for pre-numbered document. They don't account for this. And as a result, we could have a deficiency when it comes to occurrence. So this is a potential deficiency. Also, there is inadequate control to evaluate and ensure prompt recording of transaction. They don't record transaction in a timely fashion. We have also a deficiency when it comes to timing. So when we looked at their controls, this is their controls. Okay, there's a lot of them, but I just selected few controls here. And we said, are these controls meeting the audit objective for sales, which is these are all objective for sales. If it met the objective, we say C. If it doesn't, if it's failing somewhere, it's a deficiency. Now what we do is we basically assess each audit-related objective. For example, for occurrence, I'm going to say it's a medium risk. On completeness, it's low because we have 2 C's. We don't have any D's. For accuracy, low because we have controls, multiple controls about accuracy. Posting and summarization, low. Classification, low. When it comes to timing, it's going to be medium. Presentation, low, because we have at least one control activity that's meeting its objective. Now, when do we have high? For example, if we have several Ds, or all Ds for an occurrence, would say, hold on a second, this audit-related objective, it has a high risk. So this is what we did. This is how we assess. We use this matrix. Now, this is for sales. We use it for payable. We use it for payroll. We use it for inventory, so on and so forth. Now, once we determine there is a deficiencies are important because we have different types of control deficiencies. Specifically, the literature identified 3 levels of absences in internal control. We could have control deficiency, significant deficiency, and material weakness. Now, before I show you the definition of each and tell you what they are, I'm pretty sure you already figure out that the level of importance goes up. So material is the worst, significant in between, and control deficiency just simply a control deficiency. So I'm going to show you how do we come up with determination guidance on how do we determine how bad is that deficiency. So we're going to have on this line likelihood, which is likelihood are percentages, probabilities, and we're going to have materiality on the other hand. So the likelihood here is 10%, 30%, 50%, 80%, 100%. So this is the likelihood of an event occurring. And on this axis here, we have something is material, something is not material. So I'm going to start with the worst case situation, material weakness. When do we consider a deficiency as a material weakness? So I'm going to show you numbers before I show you a definition and example. Here's when we think something is really serious. When the likelihood of that event is high. What does it mean the likelihood of that event is high? Well, if we look here, it's 10%. So the likelihood is 80 to 100. The likelihood is high, and that deficiency is material in nature. So simply put, if the issue falls in this quadrant here, this quadrant is likelihood is high, more than 80%, and it's in the material. And if something happened, the problem is serious. So this is where material weakness will fall. It means high probability, the likelihood of the event happening. And what I mean by high probability, it means the deficiency is not good enough to protect from a serious weakness. Okay, so if that's the case, this is material weakness, and that's the worst. How about control deficiency? Control deficiency could be the likelihood is low and the amount is immaterial. So someplace in here, we would say it's a control deficiency. It may not happen, and if it happens, it's not material. Also, we could also argue that certain control deficiencies where there is a high likelihood, although it's a high likelihood, the amount is immaterial. Then we can say it's a control deficiency. Significant deficiency would say, since we already took the high materiality and high probabilities, I would say material weakness will be the likelihood is low, but if that happens, it's material. So we still have to be careful. Although the likelihood is low, but if that happened, we could have a significant deficiency. Now, material deficiency is when we have several significant deficiencies. You're going to see this. But if we only have one material weakness, it could fall here. But sometimes several significant deficiencies, you're going to see the definition of material weakness will give you a material weakness. So keep those percentages, this matrix in mind as we go through the definition. Control deficiency, which is kind of the lowest type. This level is characterized by a design or execution of internal control that does not enable the company staff to prevent or identify inaccuracies. So it does not allow, specific employees in certain department. For example, a small retail business does not have any procedure in place for double checking the cash register tally at the end of each day. As a result, if an employee makes a mistake when inputting the data or theft occur, notice it could be an error or theft, the error or theft may go unnoticed. So this is a control deficiency. So it's the probability of it happening low, high, but maybe the amount is immaterial. Let's take a look at significant deficiency. This deficiency, while less severe than material weakness, it's significant enough to warrant attention. So this deficiency, maybe it has a low probability, maybe high probability, but if it happens, it's serious. Okay. For example, a medium-sized manufacturing company has established internal control for purchasing supplies. These controls don't include a review by a second person. Thus, if a person is responsible for purchasing supplies, decide to order unnecessary items or order from their friends or make a mistake in ordering, the error may not be identified quickly. So here we're talking about a whole department, not one cash register. We're looking at the whole purchasing department and no one is reviewing. So we call this significant deficiency. Now, this significant deficiency, maybe for some company, could be considered a serious deficiency if the purchase department is important, but the point I'm trying to make here, it's one department. So it's a significant deficiency. A material weakness, this level is present if significant deficiency or a combination of those deficiencies create a reasonable likelihood. And this is where I go back to the likelihood. That's why I showed you this earlier, that the likelihood of a material weakness is high. So we're in this quadrant here. Let me change colors here. We're in this quadrant. High probability and material, and the issue is serious. For example, a large public company does not have internal control function, or if they have it, they don't really, worry about it. No one listen to them, despite handling millions of dollars in transaction each year. So notice the difference here versus one individual versus the whole company that was affected. This lack of oversight provided an opportunity for significant fraud or error to occur, which could materially affect the whole financial statement without being detected in a timely manner. Here we have material weakness. Again, the problem is serious. The likelihood of that happening high. We have a material weakness. Significant deficiency, well, it is important, but it doesn't rise to a material weakness because, the likelihood is not high, or maybe the severity is not great to the company. Control deficiency, something is wrong, but it doesn't threaten a whole department or the whole company. Now, what happens if we find deficiencies, if the auditor finds deficiencies? And if you remember from the prior session, we found 2 deficiencies, which I mentioned in this session as well when we did the internal control matrix, is pre-numbered invoice are not accounted for. The first thing we kind of look at when we have a deficiency in internal control as auditor is there a compensating control? What's a compensating control? Compensating control is, they don't do this, but they do something else, not traditional, not technically an internal control step that compensate. For example, let's assume the president of the company reviews every order. Then that's fine. Then pre-numbered invoices are not a big deal because there's a compensating control. So what's the potential issue here? We could have duplicate sales invoices. Could be potentially material if we have a lot of them. So when we do an audit, we have to look for duplicate invoices, maybe using software or data analytical tools. Or we might perform analytical procedures. We might compute gross margin for analytical procedures for that matter, and to see what impact does this error have on the overall internal control. Also, the company don't perform an independent comparison of dates on shipping documents to dates recorded. So they don't compare the shipping to the recorded date. Sometimes there might be some mismatch. Is there a compensating control? Yes. On a weekly basis, unmatched and unrecorded shippers are reviewed weekly. So on a weekly basis, they kind of do this, but not on a timely fashion. What's the potential in the statement? The compensating control will take care of that. Materiality, not material, because we have a compensating control. What's the effect on the audit? Not really, because already we have a compensating control. So when we find a deficiency, we don't let it go. We want to see what's its impact, and oftentimes we're going to communicate these deficiencies, which we're going to see next, to the company, to the board of directors. Let's talk about communication to those in charge with governance. So who do we have to talk about when we have a problem? Well, if we have significant and material, okay, we have to communicate this information on a timely manner to those in charge, including senior management, board of directors, and the audit committee. Those are serious stuff, serious problem in internal control. If these deficiencies are identified early, there's a chance for corrective action, leading to the auditor concludes at the end that they are operating effectively. If they fix it by the end of the year, that's fine. The sooner these issues are addressed, the better. Now, also, we have something called the management letter. The management letter is a little bit different. It outlined less significant internal control, provides an opportunity for client to improve their operation. We'll give them something like this, a list of all the deficiencies, control deficiencies, and look, you might want to do this and do that. This is the value-added service that can have a substantial benefit. We want to stay away. We want to make sure we are not violating our independence the way we present this information. Now let's take a look at a multiple choice from Farhat lectures that cover this topic. The following scenarios would be most probably considered by the auditor as a material weakness. Remember, we have 3 levels of deficiencies in internal control. Just a control deficiency, a significant deficiency, and a material weakness. So let's take a look. Starting from the bottom D, Bank reconciliation are performed on a monthly basis. Actually, that's not even a deficiency. That's something we need to do. It's a good thing. So this is definitely D is out. The company's CFO retired after 10 years of service by the company. There's not much we can say about this. 10 years is a decade. That's not a short period of time. If I have to guess, that's not even a material weakness. You know, they retired. They did not even leave the company. Okay. The company's top management has experienced a high turnover during the last 5 years. This looks like a good candidate. There's a high turnover. That's not good. That's not a good sign usually. But is this a material weakness? I'm not sure. Based on this information, I will not consider material weakness. It's not a good indication of control environment, but not a material weakness. A, the company's financial controller, this should be a controller, was charged with stealing assets from the company. Now, the CFO of the company financial controller, is stealing money from the company. Well, let's think about it. Financial controller is on top accounting. Basically, maybe they're in charge of designing, implementing internal control. So they have their hands everywhere. Not only stealing asset from the company, they are involved in many other aspects of the asset. Would this be a problem to the company? Problem to the internal control? Well, look, if the person in charge is stealing, I'm gonna just, turn on my red alarm, say, just guys, be careful. We have to be very careful in this company. So this is a material weakness in internal control. Material weakness. For one thing, how were they able to steal assets from the company? Here we're assuming stealing, obviously. We're assuming cash. How were they able to cover their tracks? Because there should be internal control. And if that happened, automatically this is a material weakness in internal control. Therefore, I can eliminate B and say, okay, I can comfortably go with A. What you should do now, go to Farhat Lectures, look at additional MCQs, whether you are a CPA exam candidate or an accounting student taking an audit course. Invest in yourself. Good luck, study hard, and stay safe.